Welcome to TalkTickers. Today, we're going deep on the travel and leisure second quarter 2025 earnings call. Our mission, like always, is to really cut through the noise, pull out those critical insights, maybe some surprising facts, and just make sure you get informed without, all the usual overload.
Yeah, travel and leisure, they certainly gave us a fair bit to talk about for Q2 25. Overall, a very solid quarter, I'd say. They showed growth on both the top and bottom lines.
Okay, so starting with the top line.
Right. We're looking at revenue over $1 billion for the quarter. That's up a healthy 3% compared to last year.
$1 billion. Okay, solid start. And what about profitability, adjusted EBITDA?
Adjusted EBITDA hit $250 million. Now, that's a 2% increase from the prior year, but importantly, it landed right smack in the middle of their own guidance.
Which is always good to see. Shows predictability.
Exactly. And if you look at the first half of the year, it actually translates to a pretty robust 4% adjusted EBITDA growth. So good momentum there.
And earnings per share, how did that look?
Adjusted EPS saw an even better jump, up 9% in the quarter. Healthy increase.
Nice. Now, something that always catches our listeners' attention is shareholder returns. What did they report there?
Yeah, this was a key highlight, I think. The company returned $107 million in adjusted free cash flow back to shareholders just this quarter.
Okay, $107 million. How did that break down?
So $37 million of that was dividends, and then a pretty substantial $70 million went to share buybacks. They actually managed to retire over 2% of their outstanding shares just in Q2.
Wow, retiring 2% in a quarter through buybacks is significant. So you've got decent growth, hitting guidance, strong shareholder returns. Where's this performance really coming from? What's the engine?
Well, management was pretty clear on the call. The overall strength, it was really propelled by their vacation ownership business. That segment was strong enough to more than offset a bit of softness they saw in the travel and membership side.
Okay, so the core vacation ownership, or VOI, business is the key. Let's dig into that then.
Absolutely. That VOI segment is clearly the growth engine. It delivered really robust results again. Revenue there grew 6% to $853 million.
And EBITDA for that segment?
Also up 6%. So You see that synchronized growth, top and bottom line within their core business, very consistent.
What about the underlying metrics that drive that? Things like tour flow, VPG.
Good question. Tour flow, which kind of indicates new sales activity, it improved sequentially and was up 3% year over year. So getting more people through the door.
Okay, 3% tour flow growth and VPG, that's volume per guest, right?
Exactly. And that number was, frankly, quite impressive. It hit $3,251.
$3,251, how does that compare?
Well, it actually smashed the high end of their own guidance range. And it marks a 7% increase from last year.
A 7% jump in VPG is pretty significant. What does that really mean for the business?
It's incredibly important. Higher VPG means more efficiency, better profitability per interaction. They're not just getting tours, they're closing deals at higher price points.
So it's boosting transaction sizes.
Definitely. They mentioned the strong VPG contributed to a double-digit increase in the average transaction size. And interestingly, management didn't just credit strong demand. They also pointed to effective upsell strategies and better sales force productivity.
So it's operational execution, not just riding a wave.
Precisely, which ties into this narrative they pushed about their consumers.
Ah, yes. The idea that their customers see vacations as essential, not discretionary. Can you unpack that? Because it seems counterintuitive given broader economic worries.
Right. It seems like their customer base is structurally different. We're talking over 800,000 owner families, the average tenure. 17 years. These aren't impulse buyers.
17 years is a long time. What about their financial profile?
Very solid. Average household income is around $118,000. And crucially, for their quite large $3 billion loan portfolio, the average FICO score is above 720.
Over 720 average FICO is strong.
And it gets better. For new loans that are originating now, the average FICO is 746. That's up more than 20 points and they tightened their credit standards.
Okay, so financially stable, long-term, committed owners. That paints a picture.
It really does. It suggests this isn't just about wanting a vacation. It's woven into their lifestyle, their financial planning. These people are planners.
And how does that show up in their travel behavior?
Well, these owners take, on average, 4 to 5 vacations a year. Over half of those are used through their ownership. And get this, 80% of owners have completely paid off their ownership.
80% are fully paid off. That's incredible. That speaks volumes about commitment and low churn risks.
Absolutely. And what's also promising looking forward is they're seeing consistent interest from younger generations. Over 65% of new buyers Gen X, Millennials, Gen Z.
So it's not just an older demographic product anymore.
Not at all. They seem drawn to the flexibility, the convenience, the personalized experiences. It's adapting.
Which is quite a contrast to the general macroeconomic noise we keep hearing about. Did management comment on whether that noise is actually impacting them? Booking pace, for instance.
Interestingly, no. They reported no significant change in buyer behavior. Booking pace is holding steady, relatively consistent, and they have this clear 109-day average booking window.
Which gives them pretty good visibility, I imagine.
Excellent visibility.
Yeah?
And reinforcing that stability, over 75% of their revenue comes from predictable sources. Owner upgrades, financing income, management fees. It's not all reliant on new sales.
75% predictable.
Yeah. And they translate that into a nearly $20 billion pipeline of potential future revenue over the next decade. That kind of visibility is pretty rare in the travel space.
No kidding. Okay, let's talk credit quality. Crucial for this kind of business.
Yeah.
How are loan losses and delinquencies looking?
Right on track, basically. Loan loss provisions and delinquencies were in line with their expectations. They're projecting a full-year provision rate around 21%.
Any worrying trends under the surface there?
Actually, the opposite. Delinquency trends apparently moderated after a small uptick in Q1. They continue to improve through Q2 and even into early July. No signs of material problems.
The stable to improving.
Yes. And management even hinted that over time, they see potential for those provisions to maybe trend below 20%. That would free up capital, boost efficiency.
And if a loan does go delinquent?
They emphasize their inventory recovery process. They seem very efficient at taking back that inventory, and then they can reprice it and resell it at favorable rates with a cost of sales under 10%. So it's a strong backstop.
Got it. A very resilient picture for the core VOI business. But you mentioned softness elsewhere. Let's switch gears to the travel and membership segment. What happened there?
Yeah, that segment definitely faced some challenges. Revenue was down 6% to $166 million. Adjusted EBITDA fell 11% to $55 million.
Okay, down 6% and 11%. What drove that weakness?
They pointed to two main things. One was ongoing industry consolidation M&A activity happening in the broader travel space. The other was an unexpected hit from some recent M&A that disrupted volumes from certain affiliates they work with.
So more structural industry issues and maybe some external shocks rather than internal problems.
That seems to be the read, yes. It's not reflecting on the core vacation ownership demand.
How are they responding? Just writing it out?
Well, they acknowledged the challenges, but stressed they're focused on maximizing cash flow and staying flexible operationally within that segment.
Any bright spots within that segment at all?
There was one, actually. Their specific travel club business, which is part of that segment, saw a 7% increase in transactions in Q2.
Oh, interesting. So not all bad news there.
No, it suggests maybe some targeted strength or adaptation within that specific offering, even if the overall segment is down.
Okay. Beyond navigating headwinds, growth is obviously key. What are they doing on the strategic investment front? Technology, marketing?
They're definitely investing. Big push on digital engagement. The Club Wyndham app apparently has 162,000 downloads now, accounts for 19% of bookings.
19% through the app is quite high.
It is. And they're launching the WorldMark app in Q4. Plus, they talked about progressing with AI investments, personalized recommendations, smoother booking on web and app. It's about deepening that owner relationship.
Makes sense. What about bringing new people into the fold? New partnerships or brands?
Yep, they announced a new exclusive marketing partnership with Hornblower. The experience-based tourism company. Operates in like 22 destinations.
Ah, Hornblower Cruises and Tours. Okay.
Exactly. The idea is to tap into Hornblower's customer base to generate new owner tours and experiences. Seems like a smart, potentially efficient way to widen the funnel.
And this feeds into their multi-brand strategy, right? Expanding beyond Club Wyndham and WorldMark. How are those newer ventures doing?
They seem to be gaining real traction. Margaritaville Vacation Club, for instance, they've expanded as Nashville, cruise ships, and it's showing double-digit year-over-year sales growth.
Double-digit growth is strong.
Any others? Yes. The Accor Vacation Club in Asia. They launched it successfully, expanded it, opened the first resort in Indonesia. This is a big strategic play, leveraging Accor's huge international presence outside the U.S.
And sales growth there.
Also double digits. Yeah. So these new brands aren't just concepts. They're delivering growth in new markets, new demographics.
And then there's the Sports Illustrated Resorts venture. What's the latest there?
They announced a new location in Nashville, about 185 units, aiming to open spring 2026, with sales starting late next year, end of 2025.
Okay, Nashville. Any others planned?
A Tuscaloosa project is lined up for early 2027. and they expect to announce a third Sports Illustrated resort sometime this year. So there's a clear pipeline there extending into different lifestyle segments.
So if you add up Margaritaville, Accor, Sports Illustrated, what's the overall goal with this multi-brand approach?
The goal seems to be sustaining their current growth rates over the next, say, 5 to 7 years. Each of these new brands is expected to potentially contribute $200 to $400 million in sales individually.
$200 to $400 million each. That's significant scale.
It is. It's about tapping into completely new databases, new addressable markets. While the U.S. is still the core timeshare market, things like Accor give them that international growth kicker, apparently with similar profit margins and minimal currency risk. It's a well-thought-out diversification.
Okay, growth strategy makes sense. How are they funding all this? Let's talk capital allocation, liquidity, balance sheet.
They generated strong cash flow in the first half, both adjusted free cash flow and operating cash flow, helped by that sales efficiency we talked about and a capital-efficient approach to development.
And their liquidity position.
Ended the quarter in a strong spot. Over $800 million in total liquidity, including $212 million in cash on hand.
What about debt? Leverage levels?
Leverage stood at 3.4 times net debt to EBITDA. They expect it to finish the year below that level, so manageable.
Any recent financing activity?
Yeah, two notable things. They successfully amended their big $1 billion revolving credit facility, extending its maturity. And they completed a $300 million ABS transaction that's asset-backed securities, basically selling bonds backed by their timeshare loans.
And how was that ABS deal received? Pricing?
Very well, it seems. The coupon was 5.1%, which they highlighted as the lowest they've achieved since 2022. That signals good market confidence in the quality of their receivables.
So, strong liquidity, manageable leverage, good access to capital markets. What does this signal about their overall capital allocation plan?
It looks pretty consistent. The priorities seem clear. First, reinvest in high-return growth opportunities like these new brands. Second, maintain a strong, resilient balance sheet. Third, return excess cash to shareholders like we saw with the buybacks and dividends, all while keeping flexibility. It's a balanced playbook.
All right, let's look forward then. Guidance for the rest of 2025. What are the key numbers?
For the full year, they're sticking with their adjusted EBITDA forecast, $955 million to $985 million. That confidence seems firmly rooted in the strength of the vacation ownership side.
And for the current quarter, Q3.
They're projecting adjusted EBITDA between $250 million and $260 million, so pretty much in line with Q2 performance.
What about sales? Gross VOI sales expectations.
Full-year gross VOI sales are still expected between $2.4 billion and $2.5 billion. But here's an interesting tweak. They actually raised their full-year VPG guidance.
Oh, after that strong Q2 number.
Exactly. They bumped the range up to $3,200 to $3,250 for the full year. That signals increased confidence in their ability to maintain that higher transaction value.
That's a positive signal. Anything else on the outlook? What about that softer travel and membership segment or new owner growth?
They expect travel and membership to likely remain challenged through the end of the year. No quick fix there. But they do anticipate an acceleration in the mix of new owners. They're aiming to get closer to their long-term target of 35% new owners, up from around 30% currently.
Then how will they achieve that?
They expect an increase in tour flow in the second half of the year, building on the momentum they saw picking up in Q2 and even early July. So actively work in that pipeline.
Okay, that covers the results and outlook. Now let's shift gears to our not financial advice segment. Time for an outrageous but plausible trade idea based on this deep dive.
All right, let's get creative.
The setup seems pretty clear. Travel and leisure paints this picture of, well, resilience, driven by this committed, financially solid customer base that genuinely sees their product as essential. It feels quite different from the narrative around broader discretionary spending cuts.
Right. Even with those headwinds in the travel and membership segment, the core VOI business with those high FICO scores, the recurring revenue streams, that efficient asset recovery, it just feels insulated, you know?
Exactly. So the pitch, what's the trade?
Okay, how about this? Consider a pair trade. You go long travel and leisure, ticker TWL. And at the same time, you short something more broadly exposed to general discretionary travel spending, maybe a high beta travel ETF, or perhaps a pure play hotel or lodging REIT that's more sensitive to transient, less committed travelers.
Long TWL, short, broader discretionary travel. What's the core rationale behind that pairing?
It's really a bet on TWL's specific narrative and customer base. You're saying, I believe their customers are different, that travel ownership is essential for them, not just a luxury. The company's underwriting discipline and inventory recovery help de-risk the long side and the short leg. The short leg acts as a hedge. If broader market sentiment sours on all things travel due to macro fears, that short position could offset losses or even profit, while you're hopefully capturing the unique resilience of TWL's core business. You're isolating TWL's specific strength. It's a bet on durable demand from a premium committed niche, even if the wider environment looks choppy.
Interesting. A bet on segmentation and resilience within the travel sector.
Yeah, playing the divergence, but very important reminder here.
Ah, yes, the disclaimer.
This is purely for discussion, right? Illustrative purposes only. It is absolutely not financial advice. Investment decisions always carry risk. Please do your own homework, your own due diligence.
Couldn't say it better. Okay, so to wrap things up, Travel and Leisure's Q2 really highlighted that robust, almost insulated performance of its core vacation ownership business. You've got this loyal, financially sound customer base acting as bedrock.
Yeah, and while there are headwinds in that other segment, the strategic moves, the new brands, the partnerships, plus that disciplined capital allocation, it does position them, it seems, for continued value creation down the road.
We hope this deep dive into Travel and Leisure's earnings call gave you some valuable insights, maybe spark some new ways of thinking for your own analysis.
Perhaps think about where else you see this essential versus discretionary dynamic playing out in other sectors. It's an interesting lens.
Definitely is. Well, thank you for tuning in to TalkTickers. We really appreciate you joining us, and we look forward to keeping you updated on the market's most important earnings calls next time.